Welcome to the Explainer. If you've ever tried trading the New York opening bell, you know it literally feels like stepping into a blender. It's crazy out there. But today, we're going completely mechanical. We've got a clear, step-by-step blueprint straight from the T-Trade's Fractal Model. It's designed to help you conquer that notorious U.S. Open volatility and really evaluate your U.S. Open entry with absolute precision. Let's be real for a second. How many times have you carefully set up your charts, waited patiently for that 9:30 a.m. bell, jumped in on a breakout, only to get hit with an immediate, account-draining reversal? You know the exact feeling, right? You get stopped out and then you just sit there watching the market rip exactly in your original direction, completely without you. It is the ultimate pain point for day traders. So why does this keep happening to so many of us? Okay, let's dive into this. The absolute number one reason traders get chewed up at the open is because they are skipping the macro. They zoom straight into the 1-minute chart and completely ignore the higher time frame narrative. Listen, if you don't know what the daily chart is trying to do, you literally have no business executing on a 5-minute chart at 9:30 a.m. It's that simple. The macro always dictates the micro.
So here is our roadmap for today. 1. The US Open Challenge. 2. Finding your daily bias. 3. The power of SMT. 4. Mastering candle closers. And finally, 5. Executing the US Open. We're going to build this strategy piece by piece so you're fully equipped by the time we hit the opening bell.
All right, jumping into Section 1, the U.S. Open Challenge. Let's talk about facing this morning chaos. We really need to acknowledge just how chaotic the market is between 8 a.m. and 9:30 a.m. New York time. It is a total morning minefield. You got these insane 9:30 a.m. volatility spikes that can sweep highs and lows in a matter of seconds. You're dealing with false breakouts, instant stop-outs if your stop is too tight, and just a general lack of directional clarity if you're only staring at the intraday noise. Honestly, trading the open without a higher timeframe framework, that's not trading. That's just gambling. To solve this, we use what's called a fractal model. Think of it kind of like a set of Russian nesting dolls. The biggest outer doll is your daily chart. That's the foundation, your macro weather report, so to speak. Inside that is the hourly chart, and that's where we actually find our specific setup. Then, the smallest doll tucked inside is your 15-minute or 5-minute chart, and that one is strictly for execution. You really can't properly evaluate a US Open entry on the 5-minute chart unless those hourly and daily dolls are perfectly aligned first.
Moving on to Section 2, finding your daily bias. Let's just slow the pace down a little bit here, because this is the absolute bedrock of everything we're going to do. Before 9:30 a.m. even rolls around, you absolutely need a one-sided bias. To find that, we are looking for relevant swings on those higher time frames. Now, what exactly is a relevant swing? It's a true extreme in the current price range that has valid, clear separation from other highs or lows. We definitely don't want to trade away from tightly stacked highs, what the source material calls failure swings. No, we want structural extremes that actually hold real weight, because markets just do not reverse without a valid swing point.
So the crucial point is how the daily candle actually closes relative to these swings. If the daily chart closes below the previous day's low, well, that dictates a continuation lower. But if it sweeps a low and then closes back inside the previous day's range, that's your reversal signature. This one simple rule is brilliant because it forces you to stop predicting and start reacting mechanically. If you have a clear closure, boom, you have your daily bias. If you don't, you just sit on your hands and wait.
Okay, on to Section 3, the power of SMT. Let's get our early warning radar set up.
You can think of this as your radar equipment for spotting genuine market turns. SMT stands for Smart Money Tool. Basically, it's a divergence between closely correlated assets. For instance, imagine the market's pushing lower. Asset A sweeps below a key previous low, but asset B, which usually moves right alongside it in tandem, fails to take out its own corresponding low. That divergence right there is an SMT. And the golden rule here is that markets rarely, if ever, reverse without an SMT. It's our absolute ultimate confirmation signal that a manipulation has just occurred.
And this brilliantly illustrates exactly what we're looking for. To easily spot these divergences, you should view correlated markets as a triad. So if you trade indices, you are comparing the NASDAQ, the S&P 500, and the Dow. In Forex, it's the dollar index, the euro, and the pound. And for gold, it's the GC futures, gold priced in euros, and gold in pounds. So if the S&P sweeps a low but the NASDAQ refuses to follow, there's your SMT. That is your big green light indicating a reversal is highly probable.
All right, picking up the pace a bit for Section 4, Mastering Candle Closures. We are getting into the mechanical confirmation.
So we've got our bias, we've got our SMT divergence, but we still need precise mechanical candle logic before we even think about clicking buy or sell. In this fractal model, every single turn in the market has very specific candle sequences. Candle 2 is your reversal candle. It sweeps the previous high or low, but forcefully closes back inside the range. Candle 3, on the other hand, is your continuation candle. It does not sweep the extreme. Instead, it completely engulfs the body of Candle 2. Candle 2 tells us the market is turning. Candle 3 gives us the confirmed green light to jump straight on that new trend.
And wick size is absolutely vital here. As the model emphasizes, quote, we want to be trading expansion candles which have small wicks that support expansion. If a candle opens, makes a super shallow move in the opposite direction, and then just aggressively expands, well, that small wick strongly supports a one-sided directional move. If you're seeing a massive choppy wick, that just means price is spending half its time going up and half going down. We want to evaluate our US Open entries specifically on those small wick setups, because those are what practically guarantee explosive expansion.
Section 5. Executing the US Open. This is it. We have our bias, our SMT, our candle logic. It's time to trade the New York Open. This is the main event right here. Here is your literal morning timeline for execution. Pre-market, you are busy establishing that daily and hourly alignment. At 8 a.m., the market opens and we are immediately hunting for that initial wick formation. You know, that shallow opposing run we were just talking about. Then at 9:30 a.m., the bell rings, injecting all that volume needed for manipulation and continuation. And finally, post-open, you're simply managing the trade as it effortlessly expands right towards your higher time frame targets.
Let's zoom in on those 8 a.m. mechanics for a second. First, you let that 8 a.m. wick form right into a key point of interest, like a fair value gap. Next, you look across your triad for an SMT divergence. Then, you drop down to your 15-minute chart and watch for a change in the state of delivery, which is essentially just a market structure shift that closes right through a previous candle. Getting in early on this 15-minute time frame is huge because it allows you to set your stop loss safely on a protected swing, completely avoiding that violent 9:30 a.m. whipsaw.
Now, what's really interesting about this slide is how we handle 9:30 a.m. if we aren't already in a trade. If you're waiting for the bell, you're basically looking for that 9:30 volume injection to form a candle 2 closure, sweeping external liquidity and then closing right back in. Once you've got that, you are trading the candle 3 continuation. You literally just let that insane 9:30 volume fuel your explosive candle 3 expansion straight into your targets. And speaking of targets, because you are placing your stop loss tightly behind a mathematically protected swing point formed strictly by this mechanical sequence, an expansion candle is going to reliably deliver a baseline 2R profit target. That means risking 1% to make 2%. And honestly, often by just holding a portion of your trade to that higher time frame daily objective, these setups can easily expand to 4R, 5R, or even more. Look. By actually taking the time to understand your macro daily bias, waiting for that SMT confirmation, and mastering the difference between reversal and continuation candles, you completely eliminate the guesswork. You stop fighting the brutal volatility of the opening bell, and you start using it as rocket fuel for your expansion candles. So the next time you sit down at your terminal to safely evaluate your US Open entry, your bias is set, your time frame is aligned. Are you ready for 9:30?